Good evening. August 5, 2014. My name is Fausto Botelho and I am from São Paulo, Brazil. I'm authorized by Brazilian authorities to produce analysis. And I've been doing so using technical analysis for over 36 years. I make analysis every day. I produce analysis every day. I follow the markets every day. I trade every day. I run a hedge fund. Also, I help to run a hedge fund. And sometimes I just feel like having to talk, having to tell all my colleagues, technical analysts, that I did already. But today I want to talk to you, common investor. The market produced today what I think is the indication of the century. Unfortunately, is a bearish indication. And I'm going to show you why and how and what are the consequences of this bearish indication. For that, I'm going to show you the Dow Jones Industrial Index. First of all, I'm going to show you the Dow Jones Index that you probably see. Most of the people in the world look at this chart. This is the Dow Jones Non-Index. As I come from Brazil, since the beginning when I started a company that produces this technical analysis software, and that was in 1983, I started to index my charts. Why is that? Because I've lived in a 40% inflation, and believe it or not, that was a month. We had 40% inflation a month, and for that reason I index my charts ever since. Well, looking at this chart, it seems that the Dow Jones in its all-time high. It seems that today's price is well above the 2007 top and the 2000 top. But this is not true, and that is because in that period we had this inflation, 2,350%. When you put this inflation, or when you take this inflation out of this chart, this accumulation, for instance, that was held for 16 years below 1,000 points becomes a downward trend comparable of proportions comparable to 1929. And you have a whole new perspective of the Dow Jones Industrial Index, one of the most important indexes of the world. You can see 29 and you can see a downward trend from 1966 to 82, and then what jumps out of this chart is that the two tops, 2000 and 2007, were in the exact same level. Well, they are very important tops because in 2000 the market fell 42%, and in 2007 the market fell 55%. Now, what I think is the most important indication that technical analysis can ever provide us is a situation in which a very important resistance level like this one is broken, and then the market re-enters the resistance level. And this is as more important was the resistance level broken. Well, I'm telling you, I'm showing you a centennial chart, and I'm showing you what I call the mother of all resistances. I'm showing you a resistance of biblical proportions. 7 years and the market makes a top in the exact same level, and I think it's now producing a third top in the exact same level. Well, as I told you, as I was telling you, in last December the market broke this resistance level. Resistance level is a place, the exact border between lots. In the case of the Dow Jones, millions of sell orders of the people selling because it's good to sell, right? Last time the market fell 55%. Before last time the market fell 43%. So it's good to sell here. So people sell here. There's millions of sell orders here. When the bulls are able to break this range, Then they touched the stop orders of everybody that was short by these level, and place the stop order right above the resistance level. So the market rallies. When it doesn't happen and instead the market comes down again, is that because something is wrong. In this case, my friends, something is very wrong, because the market broke the most important resistance and it didn't rally, as the Americans say. No, it came back down. Now, what happened after the market came down? It touched this line. This is a very important line. Let me show you. This is a line that comes from the bottom of 2009 and has lasted for 1, 2, 3, 4, 5 years, while the market touched it for once, twice, 3 times, 4, 5, 6, 7 times. The market touched this line, and last Friday the market broke this line. Well, having broken this line, I'm able to draw Fibonacci lines, and I am allowed to forecast that the market is simply going to touch Fibonacci line. That means if the upward trend was 100%, the market is coming down. Action, reaction. Action 100%, reaction 0.38%, around 38% retracement. That's what we empirically know that happens when a upward trend like the one we've seen from 2009 until now is broken. So if that happens, the market is going to fall from today's prices to the level of 12,350, which is where the first level of Fibonacci is, and that is 25% drop. If the market drops 25%, as I think it will actually, I think it will drop even more. I think it will be becoming lower than the bottom of 2009, and with that I would be saying a more than 55% drop. But for the moment, if the market drops 25%, it will make the world 25% more poor. And when that happens, economy shrinks. Companies, individuals, they pull their brakes and everything stops, credit stops, everything stops. So this is what I think is going to happen. How to protect yourself from that? Make yourself liquid. Have money. Because whenever the market falls, whoever has money is king. Well, thank you very much for watching the video, and if you eventually liked the chart that I've showed you, you can come to our site marketposters.com, where you will find a poster just like this one I have hanged here in my wall, and you can eventually buy these posters. These Dow Jones posters. We have a poster of the Brazilian market too, Bovespa. These posters show all the events that happen from there on. 100 years of events. Very interesting. Well, thank you very much for watching, and until my next forecast. Goodbye.